Imagine waking up to headlines shouting that gold has crashed and silver has collapsed. The same assets your parents trusted, the same metals your grandparents hid away for safety, suddenly falling hard and fast. The uncomfortable truth is this: gold did not suddenly become weak, and silver did not suddenly lose its value. What actually changed was the system around them, and that change matters far more than today's price ticker. Gold and silver are not stocks. They do not grow earnings or reward patience with dividends. They sit quietly in the background until the world starts to feel unstable. That is exactly why their sudden fall feels unsettling. Over the past few sessions, gold slipped sharply from its recent highs, while silver fell even harder, erasing weeks of gains in just days. For many investors, especially in regions where gold is tied to culture and savings, this was not just a financial move, it was emotional. Gold is safety, weddings, inheritance, and trust. So, when prices drop like this, panic and confusion follow naturally. People immediately start asking how gold can fall when inflation is still high, how silver can crash when industrial demand remains strong, whether this is manipulation, or whether something bigger is breaking. These are fair questions, but most answers are not found where people are looking. To understand today's fall, you do not need to go back years, only a few months. For most of this year, gold climbed steadily, not dramatically, but consistently. Central banks were buying, geopolitical tensions were rising, inflation refused to fully disappear, and confidence in paper currencies quietly weakened. Gold thrives in uncertainty, and silver followed, though with far more volatility. Then expectations shifted, not overnight, not with dramatic news, but through subtle changes in interest rate forecasts. Markets began to believe that central banks, especially the U.S. Federal Reserve, might keep interest rates higher for longer, or at least delay the rate cuts many investors were counting on. That single belief has more power over gold prices than most headlines. Gold and silver do not pay interest, while cash and bonds do. When rates are low, holding gold feels comfortable because you are not giving up much. When rates stay high, gold suddenly has competition, and money becomes impatient. Large institutional investors do not react emotionally. They ask a cold, mechanical question: why sit in metal when yield is available elsewhere? So money rotates out, not because gold has failed, but because opportunity cost has changed. This rotation happens through futures markets, ETFs, and leveraged positions, and when it starts, it accelerates quickly. Silver suffers the most because it is more volatile. Margin calls appear, positions are forced to unwind, selling creates more selling, and price moves become exaggerated. This is not fear, this is structure. Mechanics do not care about sentiment. There is also an uncomfortable layer most people avoid discussing. Gold and silver prices are not set by physical buying and selling, they are dominated by paper markets. For every ounce of physical silver that exists, there are dozens, possibly hundreds, of paper claims tied to it. Futures, options, and ETFs create liquidity but also distortion. When large funds decide to reduce exposure, they do not sell bars or coins, they sell contracts. Paper collapses faster than reality, which is why prices can fall even while physical demand remains strong and coin shops report shortages. It feels absurd because it is. Timing also matters. This drop came as the US dollar strengthened, bond yields moved higher, and equity markets remained strangely optimistic. When the dollar rises, gold usually struggles, not because gold is weaker, but because it is priced in dollars. A stronger dollar simply means fewer dollars are needed to buy the same ounce. Silver faces an extra problem because it is closely tied to industrial demand. When growth expectations soften, silver gets hit from both sides. Investment demand weakens and industrial optimism cools at the same time. That double pressure is why silver's fall looks so violent. Here is where the irony becomes clear. While prices were falling, central banks were still buying gold. Not traders, not speculators, but countries. They are not concerned with weekly charts or market noise, they think in decades. They buy gold to hedge against debt, currency debasement, and long-term systemic risk. While retail investors panic sell, institutions quietly accumulate. It is almost comical, if it were not so costly. The real risk is not that gold and silver are falling. The real risk is why so many people assumed they could only go up. Gold is not a momentum trade, and silver is not a lottery ticket. They are insurance. Insurance always feels unnecessary until the moment it becomes essential. We are living in a strange market environment where inflation has not fully disappeared, debt levels are historically extreme, geopolitical tensions remain unresolved, and yet markets are priced for comfort. That comfort is fragile. Gold falling in this environment is not proof that everything is fine. It is proof of complacency. This does not automatically mean today is a buying opportunity. That is an easy conclusion, and easy conclusions are often wrong. Prices can fall further, especially when enthusiasm fades into indifference. Gold typically bottoms when people stop caring about it, and silver bottoms when everyone decides it is useless. We are not fully there yet. What matters most is understanding why you own these assets. If you bought gold for quick profits, this fall hurts. If you chase silver for excitement, it hurts even more. But if you hold them as protection against long-term instability, then today is mostly noise, uncomfortable noise, but noise nonetheless. And that leaves us with an unanswered question. What happens if interest rates remain high while inflation refuses to disappear? What happens if growth slows, debt expands, and confidence finally cracks? In that world, gold does not need hype. It only needs time. The real question is not whether gold and silver fell today. The real question is whether, when the system eventually reminds everyone why these metals exist, you will still own them, or whether you will be trying to buy them back at a very different price.